Hello, Bitcoiners. Welcome back to Bitcoin Daily News. On Thursday, SWIFT said 17 of the world's largest banks are ready to move tokenized bank money on a shared blockchain ledger around the clock. That is a real upgrade for commercial banks. It is not the same product as Bitcoin in your own wallet, and the difference matters if you hold keys for the long run. I'm Danny Satz. Bank ledgers can add weekend hours. Valid signatures still settle without a membership list. Both are in play this week. From Brussels on Thursday, July 9th, SWIFT, the bank-owned messaging cooperative that connects more than 11,500 institutions, said its blockchain-based shared ledger is ready for initial use. 17 banks across 6 continents are preparing to pilot live cross-border payments with tokenized deposits. The roster reads like a who's who of global finance: HSBC, Citigroup, UBS, Wells Fargo, BNP Paribas, DBS, Standard Chartered, MUFG, and others spanning Asia, Europe, the Middle East, and the Americas. SWIFT built the system in about 9 months with input from those institutions. Trade press described the stack as Hyperledger Besu, an enterprise blockchain client. The important part is not the brand on the slide, it is what the ledger does. Each participating bank can issue tokenized deposits on its own books, digital representations of ordinary commercial bank money, and use the shared ledger to move them for customers when traditional banking hours are closed. Money can travel overnight or on a Sunday. Final settlement still completes through the regulated payment rails banks already use. SWIFT is explicit that this sits alongside existing infrastructure, not in place of it. Think of it as a shared whiteboard for banks that already have relationships with each other. The token is still a claim on a specific institution. The ledger coordinates timing and messaging so those claims can shift hands before the slow machinery of correspondent banking catches up on Monday morning. SWIFT also noted that 75% of payments on its current network already reach beneficiary banks within 10 minutes, and often in seconds. The new ledger is aimed at the gap that remains, always-on movement for regulated digital balances when correspondent banks are not staffed, without throwing away compliance, credit, and control standards embedded in today's systems. SWIFT tied the project to broader industry goals for faster international transactions. The cooperative's messaging network already moves an enormous share of global trade finance traffic. This is an upgrade inside that world, not an exit from it. So that's the pilot. SWIFT has not published a date for general availability beyond the 17 bank group. CoinDesk and Blockhead both frame the step as production ready for early adopters, not as a finished global rollout. To see why Thursday's launch is not Bitcoin, it helps to separate 3 words people mash together: blockchain, token, and money. A tokenized deposit is a bank's IOU in digital form. It is a claim on HSBC, or Citi, or UBS, redeemable under that bank's rules, inside that bank's legal perimeter, with that bank's risk setting on the balance sheet. When SWIFT says tokenized commercial bank money, that is what they mean: faster pipes for claims that already existed. Bitcoin is a different species. No issuer, no redemption desk, no cooperative membership list deciding who may run a node. You hold a private key, you can verify a spend against public rules, and the network does not ask which bank sponsored your account opening. SWIFT's history makes the contrast sharper. Since the 1970s, the cooperative has been the plumbing for interbank messages: who is paying whom, in what currency, with which references. It modernized speed and reach for institutions that already trusted each other through regulation and correspondent relationships. Thursday's ledger is the next layer of that story, adding a shared orchestration surface for digital bank liabilities. That is why the word token keeps confusing people. In bank marketing, Tokenized deposits mean digitizing a balance that the bank already owes you. In Bitcoin culture, token sometimes means any on-chain representation of value, including things that are not bank deposits at all. Swift's launch is firmly in the first camp. The 17 banks are not putting Bitcoin on the wire. They are putting their own IOUs on a cooperative ledger they jointly operate. Bitcoin's story is orthogonal. It was built so two parties do not need a shared institution to agree that a transfer happened. The verification is public. The supply schedule is public. The cost of rewriting history is computational, not a board vote at a Brussels press conference. A permission validator can be fast and polite. It cannot grant you redemption rights against an institution you do not have an account with. Bitcoin's trade-off is the opposite. Open verification, no issuer, no redemption desk. Property you can hold offline if you choose to learn how. So what does Swift's pilot mean if you are holding bearer Bitcoin for years, not trading bank equities? First, it does not change your keys, your wallet software, or the rules at block 957,000 and change. You do not need Swift's permission to receive sats. No pilot list includes or excludes your address. Second, it is still useful news because it shows where incumbent finance is investing. Banks want weekend liquidity and programmable movement for regulated balances. They are willing to say the word blockchain in public to get it. That tells you demand for faster settlement is real. It does not tell you banks have reproduced Bitcoin's open ledger. Finally, the contrast with open spending rules is worth some time because it clarifies the direction of travel. In March, Block's Square unit enabled Bitcoin Lightning payments by default for roughly 4 million US merchants, with incoming Bitcoin converted to dollars at the register if the merchant prefers. Steak 'n Shake has rolled Lightning across hundreds of US locations, with company executives citing roughly 50% savings on card processing fees for Bitcoin checkouts. That is the open side. Bearer asset, public network, merchant opt-out rather than bank membership. Swift's pilot is the permission side. Bank liabilities, shared cooperative ledger, legacy settlement at the end. Both can grow at the same time. They solve different problems. Fourth, do not let price action bully you into the wrong lesson. Bitcoin has been trading near $64,000 this week, while macro headlines churned. Some market write-ups even listed Swift's launch alongside regulatory hope as part of the bid. Correlation on a chart is not proof that bank deposit tokens are substituting for sats in portfolios. ETFs, geopolitics, and flow data can move the tape on the same day a bank cooperative ships software. The structural question is separate. Did anything in Brussels change who can issue Bitcoin or how your node validates a spend? For long-term holders, the practical takeaway is classification. When you read blockchain in a bank headline, ask what is being tokenized. If the answer is deposits at HSBC, you are watching claims move faster. If you already converted savings into sats you can sign for yourself, you are holding a different instrument entirely. Confusing the two is how people end up thinking adoption of bank ledgers automatically dilutes Bitcoin's role. Bank ledgers improve bank money. They do not mint new sats. Your job is to know which layer you are on. If a 17-bank cooperative ledger fixed settlement for everyone, who would enforce the 21 million cap on Sunday afternoon? Well, nobody at Swift would. That job never belonged to them. Their ledger orchestrates bank-issued tokens among members who already trust each other's compliance departments. Bitcoin's network still asks only whether the signature is valid and the coins follow the rules. The Brussels announcement did not alter that test. Some commentators say Swift going live on a blockchain proves banks won and Bitcoin is obsolete as a payment story. That version sounds like this. If HSBC and Citi can settle tokenized dollars 24/7 on a shared ledger, why would anyone need a public chain with volatile fees and no customer support line? The gap in that argument is the asset. Swift's pilot moves tokenized deposits, which are bank liabilities, faster among banks that already have accounts with each other. Bitcoin moves a bearer asset with no issuer on a network where verification is open to anyone running a node. Banks improving weekend liquidity for commercial bank money does not make your cold storage stats slower, censored, or duplicated. It also does not give a depositor in Wichita the same property rights as a key holder. Speed on a permission ledger is real. It is speed inside a membership club. You hear the mirror version 2. Private bank blockchains are secretly Bitcoin, and this launch is bullish because it validates Satoshi's design. Hyperledger Besu is a useful enterprise client. The pilot still requires bank issuance, bank redemption, and final settlement on legacy rails with the same legal stack as before. There is no fixed 21 million schedule, no proof of work security budget, and no permissionless entry for validators. Calling that Bitcoin because both use linked data structures is like calling a bank wire email because both send messages. Similar tooling, different trust model. So to recap, July 9th, Swift Ledger ready for initial pilot. 17 banks, tokenized deposits, but not bearer Bitcoin. It's a new weekend and overnight movement system, but it still has legacy settlement at the end. Glad you rode along with us for this one. We will keep watching whether the pilot expands beyond the first 17 banks and whether any bank discloses volume on the new layer. Thursday's piece on Mika and AscendX walked the custody perimeter in Europe, claims on exchanges versus keys in your pocket. Today's thread is the rail underneath those claims when banks modernize their own ledgers. Until the next block, take care, stack on. See you soon.